As of 1:52 p.m. Eastern Time on this Monday, October 27, 2025, NUBURU, trading under the ticker BURU, is currently at $0.4239. That's a gain of exactly 5% on the day, with the stock trading on significant volume of over 1.6 million shares. Now, the immediate expectation when you see a 5% pop on a highly speculative, low-float stock like this is that it's just noise. It's the kind of volatility you'd expect from a stock that has been bouncing between 12 cents and 98 cents over the past year. Many traders, especially those using platforms like the Robinhood app or SoFi Invest for self-investing, likely see this as just another day trading opportunity, a quick flip. But the reality of what is happening at NUBURU is far more complex and, frankly, far more desperate than a simple chart wiggle. This isn't just a laser company having a good day. We are watching, in real time, a company with virtually no cash attempt a complete, radical transformation into an entirely different business just to survive. Most people who have BU on their watch list, perhaps in their Fidelity or Interactive Brokers account, know it for one thing. It's blue laser technology. This was the whole story when it came public. The narrative was that NUBURU's specific blue light frequency lasers were uniquely good at welding copper and other reflective metals. This, the market was told, made it a critical supplier for the electric vehicle battery boom, for advanced 3D printing, and for high-end electronics. The expectation was that NUBURU would be a high-growth, high-margin hardware supplier to industries that themselves were growing rapidly. You buy NUBURU because you believe in the EV and battery story, much like you'd buy Tesla stock or suppliers related to NVIDIA stock's data center dominance. The problem is that this expectation has collided with a brutal reality. That original business model appears to be, for all intents and purposes, a failure. The company's financial health is not just weak, it is on life support. Let's look at the facts from their last filings. As of mid-year, NUBURU had cash and cash equivalents of just over $111,000. That's not a typo. $111,000. Meanwhile, it was sitting on an accumulated deficit of over $150 million and had negative shareholder equity of nearly $45 million against $33 million in total debt. The company has a formal going concern warning, which is the accounting world's way of saying it is in legitimate danger of not being able to pay its bills and could go bankrupt. It recorded a $6.1 million impairment charge to write down its inventory and assets at a leased location, basically admitting those assets were worthless. To stay afloat, it has been taking on extremely expensive, high-cost convertible debt, including one note reported to have an interest rate of 44%. This isn't the financial profile of a thriving tech company. It's the profile of a company fighting off insolvency. This is the reality that challenges the simple blue laser story. This isn't a stock for a set-it-and-forget-it intelligent portfolio or one of the Fidelity mutual funds. This is the deep end of the speculative pool. So why is the stock up 5% today? It has nothing to do with those blue lasers. The momentum you're seeing is a follow-on from news that hit last week, which is the core of this new reality. NUBURU is pivoting hard. On October 22nd, the company announced a strategic agreement to form a joint venture with Maddox Defense. This new JV is not about welding batteries. It's about developing, manufacturing, and deploying advanced drone systems for military and commercial use. NUBURU is trying to completely rebrand itself as a defense technology contractor. The company threw out some huge numbers, estimating the NATO UAV defense market at over $7 billion annually and projecting that this new joint venture could could reach $100 million in annual revenue by the end of 2028. That announcement is what caused the stock to surge over 18% last week, and today's buying is residual speculation that this pivot might actually work. This company isn't just a laser company anymore. It has created a new entity called NUBURU Defense LLC and is trying to become a defense and security platform. This defense pivot isn't the only piece of the puzzle. It's part of a broader, multi-pronged transformation plan led by its executive chairman. To support this, NUBURU also announced it's acquiring a company called Orbit, a software-as-a-service or SaaS provider specializing in operational resilience. The goal here is to bolt on a recurring revenue software business to complement the new defense hardware angle, targeting a market they claim is worth $3.6 billion. Furthermore, they are pursuing a controlling interest in Tekne S.p.A, an Italian company with a background in defense and security, and NUBURU has been highlighting Tekne's supposed $500 million order portfolio. So, the new expectation management is trying to sell is this. Forget the cash-burning blue laser business. We are now a diversified defense and security hub, complete with drone JVs, a SaaS platform, and European defense contracts. Today's 1.6 million shares in trading volume represents the fierce debate between investors betting on that new story and those who see it as a desperate Hail Mary from a company with negative equity and no cash. This is critical for anyone looking at this stock as a potential online investment. The trading action is almost entirely disconnected from the company's underlying financial fundamentals and is instead running on pure narrative and forward-looking projections. When you see a stock this cheap, under 50 cents, it's very tempting for those practicing self-investing to think they can buy a large position and see a massive return if it just gets back to $1. But the risks here are astronomical. The company is funding its survival through highly dilutive measures. It has a standby equity purchase agreement, or SEPA, that allows it to sell up to $100 million of its stock. When a company with a tiny market cap sells stock directly into the market, it puts immense downward pressure on the share price. Every new share issued just to pay the light bill makes every existing share worth less. This is why the stock chart is so brutal when you zoom out. It's a classic battle. The bull case is that this new defense strategy is a brilliant pivot that will bring in real revenue, allowing the company to use that SEPA to raise real growth capital and escape its financial distress. The bear case is that these are just press releases, a series of hopeful-sounding acquisitions and JVs that will never generate meaningful income, all while the company continues to dilute shareholders into oblivion on its way to a reverse split or eventual delisting from the NYSE. This is not a stock like Apple stock, which is valued by trillions in assets and hundreds of billions in free cash flow. This is not even a high-growth story like Nvidia stock, which is valued on its clear and present dominance in a booming sector. NUBURU is a binary bet on a corporate turnaround that is starting from a position of extreme financial weakness. The institutional ownership reflects this. According to the latest filings, institutional ownership is incredibly low, somewhere around 1.1%. You see names like Vanguard and Geode, but these are almost certainly passive holdings from broad market index funds like the Fidelity ETFs FSMX or VEXMX, which have to buy everything. There is no significant active institutional conviction here. You don't see major Fidelity wealth management groups or large hedge funds building a position. This is a retail-dominated stock, which is why it's so volatile and susceptible to sharp moves on press releases. The big investment houses aren't touching this. The trading is happening on platforms like Robinhood, SoFi, and through Interactive Brokers by traders who understand, or at least should understand, the high-stakes game being played. So, let's look at the future scenarios. Scenario 1, the bull case. The Maddox Defense JV lands an actual, tangible contract in the next 6 months. The Orbit SaaS acquisition closes, and NUBURU can start reporting even a small amount of recurring software revenue. The Tekne deal gives them a legitimate foothold in Europe. If these things happen, the narrative will gain traction. The company could use the positive momentum to raise capital through its SEPA on better terms, clean up its toxic debt, and fund the new business lines. If they can show a clear path to positive cash flow, the stock could, in theory, be a massive winner from these 0.42 levels. This is the story the bulls are trading on today. Scenario 2, the bear case, which is grounded in the company's current financial statements. The drone JV, the SaaS acquisition, and the Italian partnership are what we call headline stacking. They are announcements designed to create trading volume so the company can use its SEPA to sell stock and raise survival cash. In this scenario, the revenues never materialize. The $100 million by 2028 projection for the drone JV turns out to be just a guess. The core business continues to burn what little cash it can raise. The 44% interest notes and other convertible debt holders convert